The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
All right, joining us now to discuss the Biden administration stablecoin report is Acting Comptroller of the Currency, Michael Hsu. Welcome to the show, Michael. So I looked at some of your comments and you described stablecoins as awe-inspiring. What did you mean by that?
So I think the technology is very, very interesting. I think that it's what it has done is really opened up avenues to do things in a new way, and that's awe-inspiring. That's interesting. I think it also comes with some risks. So we want to make sure that as that develops, and it has developed and grown very, very quickly. I don't think anyone thought we would be here today with stablecoins at over $100 billion. With the speed with which the crypto universe has developed. And that, I think, puts the onus on us as regulators to kind of understand the space, make sure that it develops safely and soundly and doesn't have any threats to financial stability.
Okay, why are stablecoins a problem when they solved a problem that the banks couldn't solve without regulation? That is more efficient cross-border payments, global liquidity, cutting down settlement times. If that's the case, why do they need regulation now?
Well, I think your question makes some assertions that each of those could be challenged or each of these can be turned over. I think it's useful to think about, to look at history. So in the history of the economy, the banking system, stablecoins remind me of pre-Civil War banking. And in pre-Civil War banking, you didn't have a dollar in the way we know it today. Each bank issued a note. And that note represented a dollar. So that looks an awful lot like a stablecoin. That system was very unstable. There were lots of runs, there were lots of panics. And it wasn't until the National Bank Act, the National Currency Act under Abraham Lincoln that created the dollar as we know it today, and which also, incidentally, is part of the OCC's history. That's when we came into existence, which resulted in a more efficient, fair, and stable financial system. And that's what we all want.
It's a pleasure to have you on the show. We have a brand new report out on stablecoins with recommendations for Congress. I was wondering if you could break down for some of our viewers who are not familiar, very specifically, what you think are the good aspects of this report, what recommendations you would agree with, and what you think is still missing or some recommendations that you think could be improved.
Sure. I think the report's primary recommendations are spot on, and that is what is the biggest risk of stablecoins, especially as they scale and that they get more used. It's that they're subject to there's run risk there. They're subject to runs, and how do we deal with run risk? Well, we know that from the banking world, we've got a way of dealing with that through a prudential framework. So that phrase, a federal prudential framework, is all about how, over many, many years, we've learned how to deal with run risks so that we get all the benefits that are provided while mitigating the risks. So that's number one. I think the other risks that have been cited with regards to payment chains risks and concentration, those are also things that we need to keep an eye on. And we're trying to get ahead of things here so that we're not constantly reacting in a way that can lead. We want to be smart about how we do this. And so part of this report is trying to look out into the future a bit and try to get ahead of that, start that conversation, so we can get these things in place. So things can. Everyone wants these things to scale. We want it to scale too, but we want it to be done safe and soundly. We want there to be consumer protections, and we don't want there to be financial instability risk.
So yes, thank you. Just to follow up on that, though. So yes, we've identified some of the risks, which are runs, but just looking at the actions that are recommended, I'm just really curious to hear your perspective on which actions you think, or which recommended actions you think are correct and which you think are not correct.
Well, I think the way the way the report's laid out is that first best would be congressional action. Because if Congress can take action, they can tailor the framework. They can do that through a deliberative process. It has legitimacy. All the voices can come to the table. We can do that in a way that's clean. That's good. That takes time. And so in the meantime, while the industry grows and expands and evolves, what are the tools we have to address it? The report talks about FSOC. FSOC has certain powers and tools. We will use those if we have to, and FSOC is actively discussing that. At the same time, we've got certain regimes which could be utilized, such as getting a national bank charter, et cetera. But those are voluntary in nature, and so the landscape, as you know, There's a variety of players out there. And what I've been trying to get out there to talk about is, well, let's try to use the tools that we have so we can differentiate between safe and sound stablecoins and those that are less regulated and not as safe and sound.
So, Comptroller, one of the stablecoins not subject really to run risk is Tether, because they limit how people can redeem $4. And it's an important point because more than half of all stablecoins right out there, more than half of the value is in Tether. So they operate outside the United States. What happens to them specifically? Let's name names, because the report itself just sort of hints at it. But what specifically happens to the largest player, Tether, and also to USDC, but really Tether, which is by far the market dominant player?
So I'm not going to opine, kind of hypothesize on government actions towards specific coins. I think it's premature for that. But I would note that there is a range. As you know, there is a range in how these stable coins are set up and the confidence that users have in them. And I think that when times are good, that range tends to be narrow. In times of stress, we know from the 2008 financial crisis and other stresses, that range widens. And then once there's panic, you can't put that genie back in the bottle. We know that. And so what we're trying to do is set up a regime where stablecoins are in fact stable. That is in the interest of everybody. But that's not a free proposition. That requires choices to be made. And I think that what you're seeing right now is that different stablecoin issuers have approached that differently. We're trying to lay out a path so that there's clarity on that, because we hear from you and a lot of your viewers that people want clarity. Just tell us what the rules are and we'll follow that. So we want to lean into that and be part of that conversation.
So when you mentioned different stablecoins are set up differently, obviously, some have as close to pure cash as possible backing them up. Some have come up with the innovation of having commercial paper backing them up. Should they be regulated differently based on that setup, or should it be one size fits all with stablecoins? Why not have, let's say, the SEC regulate those that are set up with commercial paper, and CFTC maybe regulate those that are algorithmic based, and you guys regulate those that are dollar based, or the FDIC for that matter? Why not just do it based on how their asset base looks like, instead of just the fact that they call themselves stablecoins?
So look, I'm open to engaging on this conversation and talking about it in more detail. My prior, without knowing more of the details of what your proposal is, my prior is that run risk, the bank regulatory framework is familiar with and knows and understands run risk. Run risk is not something that investor protection rules under the SEC or trading rules under the CFTC are good at dealing with. We know that from history, right? Money market funds are regulated by the SEC. Money market funds have had endured runs, and that's one need to look for. March of 2020 last year, 2008. Those runs can be very destabilizing, have broader impacts on the economy. We want to make sure that those are prudently managed. And again, the bank regulatory framework knows how to do that. But I'm open. I'm open to ideas on how to approach this. My experience is that the fine nuances of what you talked about, Lawrence, would be lost on the public. As a practical matter, I think the public is going to say, a stablecoin's a stablecoin. Let me just trade in it until there's stress. And then people start looking at the fine print, and those reaction functions we have to take into account. And we have experience with that. So we want to bring that experience to bear.
Yeah, I guess following up with Lawrence's comment, if based on the different asset backing of stablecoins, do you see different regulatory agencies in the U.S. Having oversight over different stablecoins based on that asset backing?
Not at this time. Again, I think we're getting ahead of ourselves. I think what we're talking about here is a proposal. I haven't heard a proposal along these lines, and I think it had to be fleshed out considerably more to be taken seriously. But let me just note, in the bank space, the way banks hold high quality liquid assets to deal with runs, those portfolios vary. It's not one size fits all. There's rules around them. We try to set those rules so that there's clarity and there's certainty, but there's also some flexibility within those rules. So we're used to that. So it's not hard for me to envision, Lawrence, like your proposal being done within a regime, within, say, a bank regulatory regime that can achieve some of that. So, but again, I think we'd have to look at the details on this. I'm open-minded about it, but I think we want to keep our eye on the ball.
Oh, well, I noticed in your
Stablecoins need to be stable.
I noticed in your comments that, regulatory arbitrage played a role in the 2008 financial crisis. And so how can you see that being avoided going forward with stablecoins? Is it that all agencies should find some sort of unified way to deal with stablecoins, or different agencies will react to them differently?
So I think, and thank you for highlighting that. So this is something I feel really, really strongly about. The number one way to stop regulatory arbitrage is for the agencies to cooperate and to get on the same page and to basically lock arms as to what the vision is for going forward. And I think that's really, really important. We all have our individual mandates. That's not going to change, but we can coordinate on how we do that. The PWG report on stablecoins is a great example of how we can do that. We came together. We basically said, okay, how are we thinking about the risks? How are we thinking about the recommendations? Let's do that together. And what that does is it prevents us from basically setting up our own sets of rules and then getting arbitraged by players out there who want to pick and choose from different parts of those rules. This, I think, provides a healthier way to move forward. There's a lot of devilish details. I don't want to get in front of, we have a long way to go, but I think it's a good start to preventing what you're talking about.
So does the OCC or any other agency that you can think of have a problem with US dollar-based stablecoins, issuing those stablecoins against non-US dollar currencies or other assets, but denominated in one-to-one US dollar? Such as, let's say, commercial paper, for instance, has been one topic that people have talked about, but it could be other assets. Is there kind of an issue, a worry that this is effectively money printing that can happen on a grand scale if that's the case, if it allows non-US dollar currencies, for instance, to be used as that currency to purchase those stablecoins?
I see. Well, I think there's two things here to unpack. So one is, and again, I'm going to sound like a broken record, but the number one thing to guard against is run risk. That is number one. So whatever we can do to mitigate the risk of a run, that is job number one. Within that, should there be flexibility? Yes. Like we need to have flexibility within those bounds. But we have to be very careful about trading off the flexibility for run risk. We've seen this before in the past, because again, confidence, once you lose confidence, it totally unravels. And you can say till you're blue in the face that the portfolio has a value of X, but everyone says, I want my money back right now. And we've seen that. And so what do we need to do to prevent that? Within that, are we willing to be flexible? Yes. But again, we're not going to prejudge the degrees of flexibility here on this particular call. I just invite your viewers to review within the liquidity risk the LCR, the liquidity coverage ratio for banks. There's flexibility built into that. There's experience with that came out of the runs from the crisis. Review that, take a look at that, and you'll see that it's not as strict as people might be thinking, but it is grounded in kind of our experiences and analysis with regards to liquidity risk.
Let's just shift away from stablecoins for a moment to decentralized finance, or DeFi. And I was just wondering if you could talk to us a little bit about what you see as the best regulatory approach to DeFi, because DeFi is decentralized and thus difficult to regulate in a traditional way. And there have been various DeFi projects warning that if the US kind of oversteps and regulates DeFi in the wrong way, they will leave the United States. So this has been a topic. So how do you, simply put, what are your big recommendations for regulating DeFi?
Sure. So let me just start off the bat, because as the acting comptroller of the currency, I'm approaching these DeFi, crypto, the entire space with three lenses. First, what are the impacts on bank safety and soundness? That's my number one job. That's my mission, to ensure that banks are safe and sound. So to the extent that banks get involved in that space, that's my question. Second, what are the impact on consumers? Does this space help or hurt with inequality? Does it help or hurt with financial inclusion? That's really, really important. Third, what are the impacts on financial stability? And so those are the three questions I constantly ask myself as these are developing. In the DeFi space, I think right now, the safety and soundness and financial stability implications are second order. I think the primary one is really on consumers. And there are some really interesting polls that show who is getting into the space. It's not who you think. There's a Morning Consult poll that asked fully banked versus underbanked, do you own crypto? 10% of the fully banked said yes. 37% of the underbanked said yes. Who are the underbanked? Underbanked, they have a bank account, but they often need to go to a check casher or a payday lender to fulfill their financing needs. Juxtapose that. There was a Harris poll. Do you own crypto? Whites, 10%. Blacks, 18%. Hispanics, 20%. So I think we want to be really careful about who is in this space and why, and what the risks to them are. I think there is some promise of wealth creation, of empowerment, et cetera, of innovation, but there is some risk that folks who are least able to bear it lose their money. And I think we want to be really careful. That's something that I and some of my peer regulators are focused on. How do we regulate that? I think is an open question. Like the how, we're trying to figure out right now the what, and we'll figure out the how. Because as you guys know, the regulatory structure right now, it's not well set up to just apportion which agency tackles which problem. We're still figuring that out.
I want to get back a little bit to the stablecoin issue because it perhaps ties into this, and that is this. What kind of transparency is going to be needed for stablecoins to provide that they aren't currently doing right now to keep that stability? Do you think, for instance, last week we had Jeremy Allaire, the head of USDC, yep. And we asked about some of their short-term assets, and he said, look, we disclose what we're required to disclose, but the question from the market has been, is that many don't feel that's enough. They don't know how much of those assets are potentially at risk. So how much transparency is there? How much transparency still needs to come out into the market that maybe goes above and beyond what's currently required?
So this is going to sound like a flip answer, but as much as is needed to maintain confidence through different states of the world, that's what's needed. And so I have personally been in situations with either banks, non-banks, money funds, others, where there's a question of what's there, and that's the inability to answer that question confidently is what leads to the run. So you can't solve for that. Once you're in that situation, you cannot solve for it. You have to solve for it ahead of time. That's going to feel onerous. Almost by definition, it's going to feel onerous to stablecoin issuers. But again, this is a policy call. This is why we have regulation, is to help define these rules of the road and to give investors and users that confidence that, okay, what's there is there. I can focus on other things. It's not a good use of people's time to be constantly fretting about that if we can set up guardrails for that.
Nonetheless, I mean, is enough currently out there? Are the rules that whatever rules we do have enough to deal with that market pressure, that market nervousness and confidence? Do stablecoin issuers need to disclose more, regardless of where they are and who they are? Are they doing enough general right now?
In general, my answer to this is always going to be more transparency is good. So that's my general response. But again, I think what we want to do is kind of evaluate the space carefully, analyze it carefully, come to our recommendations in a smart way. So, yeah, I mean, in general, you'll hear me now say they should disclose more. But I want to be careful that that doesn't kind of become a headline. You know, the OCC requires more disclosure from stablecoins. We have to be cognizant of where our authorities lie right now, and what my word means.
What is the right balance between stablecoin risks and stifling innovation? As many folks in the crypto industry are one of the recommendations in the report is that these issuers be regulated like banks, and does that limit fintechs that are trying to issue stable coins? And folks in the crypto industry feel that that unnecessarily singles them out when payments firms like PayPal have similar functions.
So I think we want to be careful on this, where innovation, that word is getting thrown around a lot in different contexts. And I want to be really, really clear. I am not against innovation. Innovation is good in most instances. What I want to be really careful about is when you're dealing with other people's money, which is what stablecoins fundamentally are about, you want to be careful. We all want to be careful. And there are some areas where we want really unfettered innovation. Move fast, break things, iterate. That's what you want. With regards to stable coins, I would argue that is not what you want. You want your money to be stable. You want it to be reliable. You want it to be there in good times, in bad times, and not have to think about it. If you innovate too much in that space, you're going to get a wide range of outcomes and some of which are not going to be good. We've seen that in other spaces. And so, again, we're not out to quash innovation across the board. I would argue that the best way to promote healthy, productive, responsible innovation is to take those things which should be stable and make them stable, so people don't have to worry about that. And then that way you can focus the innovation energies where they can kind of have the biggest gain.
So finally, and relatedly, do you think the United States needs a central bank digital currency, i.e. a digital dollar, and why or why not?
So I know the Fed is working on a paper on CBDCs, so I'm going to withhold judgment until I see that.